Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It is Wednesday. It is October the 11th, and I want to talk a little bit about the energy economic investment thesis. So a little bit of macroeconomics. If money supply grows faster than overall economic growth, inflation will occur. And that's the kind of situation that we're in now because the governments right across the world are just dumping money into the system. If the difference between the money supply growth and the growth of the economy becomes too wide, hyperinflation occurs, again, which is sort of an example of where we are now, depending on the economic jurisdiction that you are currently finding yourself in. Now, the disparity between wealth accumulation, we hear this all the time between the haves and the have-nots, and the rich getting richer and the poor getting poorer, can also be attributed to divergent spending habits. We find that poor people often spend their money on liabilities, which are things that depreciate over time, such as luxury goods or excessive entertainment, expensive cars, etc. But have you ever really thought to yourself that the factors or some of the factors that cause poverty are also some of the factors that cause wealth, right? So these things are sort of analogous to one another, but the examples of that, just to mention a few, are energy, right? So you often hear about politicians and people complaining about the price of gas at the pump, right? So if the price of gas is high, and I'm just talking about basic energy in terms of filling up your car, as a result, almost everything that you buy, so your bread, milk, and cheese and eggs and things like that, are also costing you more money. So effectively, what you have is a situation where, as a result of something like energy, people are literally getting poorer because things that they consume on a daily basis cost them more money. On the reverse side, or the flip side of that, people who invest in energy and energy companies are making more money because the price of the commodity is higher. Now, this is true in a variety of different aspects, and some of them are direct and tangible, like energy, and others perhaps somewhat less so, like education. You could argue that people who are better educated, as a general rule, have more opportunities and better opportunities of earning more money than the reverse, right? And then, of course, we have things like conflicts and wars. People argue quite correctly that all wars are bankers' wars. And when you have conflicts and wars, there are always people getting very, very wealthy, and a majority of people suffering the consequences of those wars and conflicts are getting significantly poorer every single day. How about healthcare? So in the United States, as an example, one of the primary reasons of personal bankruptcies is the cost of healthcare, right? So this is once again a disparity between sort of the haves and the have-nots. The people who cannot afford their healthcare bills end up filing for bankruptcy, yet the people who are providing the services to them, including the hospitals, which are very frequently non-profit organizations, are rolling in cash. And then there are financial instruments like debt. Some people make an enormous amount of money on debt. Other people just end up spending more and more money because they get more and more in debt, especially as time goes by and rates increase. And then, of course, there's also the concept of time versus money, where you can say that wealthy people, for instance, are better stewards of their time than, let's say, poorer people, because poorer people, unfortunately, are forced to work lower income jobs and sell their time, which is our most precious commodity, at a significantly lower price than people who are perhaps wealthy, who earn a much better return on investments. But what I'm trying to do in terms of making these statements is not necessarily be critical one way or the other, but just as a matter of fact, state the truth in terms of that simple concept where some factors that make people wealthy, like for instance, let's say energy investments, are making other people poor, which is the lack of energy or energy investments. So building on that macro energy investment thesis, what I want to do is take a few minutes and just kind of walk you through some of the information that I found over the last week or so, and share some information with you that might be useful to you in terms of your own personal planning and financial planning. I started off here with a little bit of a look back, right? A long and winding road. If we go back to 2020, the year of the big pandemic, most recently, and then fast forward a little bit to 2021. So late 2020, early 2021, oil and gas investing was sort of done and dusted during the pandemic, right? Remember at one stage, the energy futures even turned negative for a brief period before it kind of settled at a price per barrel, which was like, what, $15 or something like that. On a sort of macro scale, the energy sector itself was completely uninvestable, and that certainly was the buy side sentiment. And the oil demand had previously peaked, and arguably the terminal value of the sector was going to be zero by 2030. In other words, it was doom and gloom, and nobody actually saw light at the end of the tunnel. Now, if we fast forward to 2023, which is just 2.5, 3 years later, global oil and gas and coal demand is the highest ever. In fact, 2024 might be even higher. How about the inventories, though? They're still well below the pre-COVID levels, and investor interest has somewhat or partially recovered, not fully yet, but there are certainly people who are basically saying now might not be a bad time to get into energy. That doesn't mean any energy, and it doesn't mean that any energy will offer you a good return on investment or any energy investment is good, but there's certainly some low-hanging fruit that you can pluck and do reasonably well. What about energy transition? So this is alive and well, right? So the difference here, or the disparity once again, is that while the developed world demands cleaner energy, the developing world demands affordable energy and lots of it. So if we look a little bit about at the energy transition in more detail and the impact of oil demand and prices, the transition for sure is real. There's no question that as the developed world moves more and more into a realm of looking for greener, cleaner energy, we are going to see more and more of the energy transition taking place. And some of the policies, of course, from the politicians include mandates and incentives. And of course, there's also the direct cost of carbon. The public interest is a little bit mixed, but certainly from a developed world point of view, there's a preference for affordability, whilst there's also a quest for greener, cleaner energy. The global energy mix has not merged with the energy transition to date for the reasons I just mentioned. There is massive energy demand growth, especially from Asia Pac, and we're going to look at that in just a minute in much greater detail. The renewable supply growth far outpaced anything else, but it's working from a really small base, right? And I'm going to show you some graphs in that regard from very, very reputable and reliable sources. Coal demand, would you believe it, has been absolutely hard to kill. Some politicians have been saying for years, perhaps even for more than a decade, that they want to shut down all the coal plants. That has not happened. Coal demand is actually not only holding steady, it's even growing. What are the implications for oil and gas? Well, there's some optimism for continued demand growth through the end of this decade, for sure, which means you have a timeline, at least over the next few years or so, and perhaps even for the remainder of the decade, where there should be sufficient oil demand for you to be able to invest in energy and make a reasonable return on your investment. The refined product demand may evolve, but we'll see what that looks like in more detail as we go. So how's this for a comparison, right? So we have an energy mix here, 2002 compared to 2022, right? So there are some really interesting anomalies here because we're looking over a 20-year period, and there's no logical reason why nuclear should have dropped from 17% down to 9%. If anything, if you're looking for clean, green, safe, efficient energy, nuclear is the answer. And that has certainly been a very, very interesting, let's call it almost borderline fatal error by the politicians to ignore nuclear because it's most reliable, clean, efficient, and green. Gas, interestingly enough, so gas is actually on the up, right? So over the past 20 years, 19 to 23%. And look at coal, 39%. And then now sort of hovering around 35%. So it hasn't actually moved much at all. The only one that's actually shown a real decline is oil, 7 to 3% over the last 20 years. So it's been an interesting environment and an interesting shift as well. The global energy production generation has increased 40% since 2002. And guess what? It's going to increase again by another 40% or so over the next 20 years. Total energy consumption has increased by almost 50%, and global per capita consumption is up about 17%. You're going to see this acronym OECD a few times during the presentation that I'm sharing with you. It's the Organization for Economic Cooperation and Development. It's a mouthful. It was basically founded by the United States, but the OECD countries are declining while Asia-Pac is increasing. And coal, as I mentioned at the top here, 39 to 35% over the past 20 years is actually holding its own. And of course, renewables are higher, but it worked off a really, really small little base. It was a tiny slither in this pie chart 20 years ago, and now it's a big chunk, but it still is hovering around 15% or so after 20 years and trillions of dollars of investment. The only two noticeable ones that are lower are oil and nuclear, which was actually quite surprising. If you look at it on a linear graph, what you can see here on the y-axis is the electrical generation by source, and then you see the percentage gas and coal on the right-hand side. But if you look at the lines over here, then you see this brown line, which is hydro. That's actually a bit of a surprise, right? Also trending sort of down, and then the other down lines are nuclear and oil. The only green arrow here, the only up line, effectively are renewables. But as we said at the start, it's working from a very low base, so it's very easy to grow in leaps and bounds when your base where you start out is very, very small. How about absolute electrical generation by source? This is in terawatt hours, right? So oil remains the only power source to experience an outright decline in power generation. But natural gas has been the fastest growing hydrocarbon power generation fuel source, and renewable growth rates are impressive, but the total contribution is still relatively modest. And despite all the headwinds, including political headwinds to coal, the absolute demand for power generation has increased quite significantly over the last decade. What we are looking at here from a consumption point of view is that global coal consumption has increased 55% over the last 20 years. And you can see the shift here because here we're looking at geography. So we have the North American markets, and we have Europe and Asia Pacific as the largest slices to the pie chart. And look at the shift from 2002 to 2022 for Asia Pacific, now making up approximately 81% of the consumption. Asia Pacific effectively accounts currently for almost 4/5, 80% of daily coal consumption in 2022. So as of last year. And that consumption per capita is up 87% since 2002. So some of these regions are showing modest downtrends, but the Asia Pacific consumption is dwarfing those downtrends quite significantly. How about 10 years of global coal consumption? So over here, you can see I've highlighted this little box here that says the North American markets in Europe could be going to coal zero or zero coal, but it would have little impact on global coal consumption. Now, what I'm saying here effectively is that from an energy investment point of view, as I said at the start, it doesn't mean that you can just buy anything, right? You could make a very decent return on renewables if you pick wisely. But ironically, you could actually make a very good return on investment on coal, and specifically thermal coal, which is used for heating and cooling, as opposed to metallurgical coal, which is used for making metals. Could oil follow coal's path across much of the Asia-Pacific region? Well, I'm not sure, but there is a possibility that as the demand for energy increases, it's not going to be limited to just coal, so we might get a resurgence in oil as well. Look at this vertical graph here on the right-hand side, and you can see the change from 2012, and this is just over one decade, to 2022, comparing North America, Europe to Asia-Pacific. The Asia-Pacific market, especially for coal, is just growing off the charts. Here we are looking at the same type of a graph, but other than coal, we're now looking at oil. So less dramatically than coal, oil consumption patterns have shifted, and the total global oil demand has increased 22% since 2002. So even though oil, as a general rule, is effectively declining, from an Asia-Pacific point of view, global oil demand is basically increasing. Now, how much higher would oil prices have been if the OECD demand had not declined? That is an interesting question to ask. But if you look at the 2002 to 2022 pie chart in exajoules, you'll see Asia Pacific was at 28%, and now it's at 37%, whilst North America went from 30 to 23, and Europe from 21 to 15. So you can see the shift has been quite dramatic. How about oil demand by product? And this is on a global basis, comparing the period 2019, so sort of where we are now, looking ahead and looking forward to 2050. So using our crystal ball a little bit and trying to see where we are going. Now, what's interesting here is I'm only going to compare this pie chart at the top left with the one on the bottom right, because the one on the bottom right is estimates for 2050. If you look at 2019, you'll see residential fuels with about 6%, and it remains sort of there or thereabouts at 7%. Gas, oil, and diesel was 28% in 2019, and it seems to be edging up to around 30%. But look at this, LPG and ethane was 13, and it's edging up to about 18%. So when you look at the actual pie chart of the global oil demand and what the smart people predict on a go-forward basis, you can actually see there are certain areas where you can achieve a lot of growth, and some of them include residential fuels, gas, oil, diesel, and LPG. So what you have to do as well is be a little bit cautious with your oil investments, because for your basic E&P producers, so the energy producers, like your Chevrons and Exxons and things like that, obviously they don't only do heavy oils, they do a variety of different products, and many of them are quite diversified as well and integrated. So they're good investments, but there are some bright spots that you just need to find as you build your energy investment thesis, as you go through this little bit of information that I'm sharing with you. How about you? From a global supply demand point of view, we have an imbalance, right? So we generally see the global oil market as balanced into the middle of the decade, says Wells Fargo Securities. Now, right now, we have these anomalies here, and we have two of them, where you can see there were huge demand, supply, and demand swings. Obviously, 2020 because of the pandemic, and then 2021 increased consumption again, and you can see we're sort of flatlining, but it's edging up a little bit. So there is actually an increased demand. And at the bottom here on the left, it says OPEC Plus is exerting force on the supply side for good and bad since 2019. Of course, it's very much in their interest to make sure that the prices are high, because many of the OPEC countries have an economy entirely based on oil. How about inventories? Well, this is an interesting slide as well, and I'm only looking here at the little snapshot at the bottom right of the screen. The global total inventories, this little dotted yellow, little black line here, this little dotted black line that I'm following with my mouse cursor here, is the 10-year average of global total inventories, right? And what we have right now is, if we look back 1 year to 2022, this is this brownish line over here, was our inventory line. You can see it's well below the 10-year average. And for 2023, year to date, as of May, this is where we are tracking. So even below 2022. So don't get too flustered when you see IEA reports and things like that, where they tell you this week's inventory is up, or this draw is higher than last week, or whatever the case might be. These things are not important from a macro point of view. The fact of the matter is inventories are way, way, way below the 10-year average. And right now, 2023 is tracking at even below 2022, the brown line compared to the purplish colored line just below it. How about the SPR? So the Strategic Petroleum Reserve, this is obviously specifically US centric, 1992 to the present day, right? So here we're looking over a period of about 30 years, and you can see where the SPR crude inventory was over that period and where it is today. So this is 2023. The decline in the Strategic Petroleum Reserve rates is one of the most dramatic in the history of the US oil industry. Now, of course, most of this was just politically motivated, right? So what you had was President Biden saying he'd like to make sure that the price at the pump remains low for his voter base, and having a lower price at the pump obviously also means lower prices for milk and egg and bread and things like that. Because effectively it's going to force a little bit of downward pressure on the cost of almost everything. What he did by doing effectively by executing on this action of draining the SPR is he's placed OPEC in a better position to support higher oil prices. And the physical capacity for storage may have been eliminated. So we have a risk situation now that we did not have before. And the problem now is that it seems as if the government has no strategic plan and perhaps not even the willpower to actually refill the strategic petroleum reserve. Of course, if they start doing that, it might cause a significant spike in energy prices as we know it today. Quick look here at drilling rig efficiency. So we have a couple. So gas rig efficiency on the left side, and on the right side, we have oil rig efficiency. And you can see over here on this brown line that the total US gas produced per day is edging right up, while the gas rig efficiency is actually going down. Now, the same thing is true for oil. The reason for that is that the US rig efficiency reflects the shale revolution for both oil and gas. And rig efficiency is not a proxy for oil and gas production, just productivity and pricing power. So as they become more efficient, there are actually less rigs, but the amount of product produced is actually relatively stable. We know this from our own experience because large companies that we follow together, like Occidental Petroleum and Petrobras and companies like that, are producing on a consistent basis, 1 million barrels per day or 2.5 million barrels per day. It hasn't changed much at all. What about the gas rig count? There's been a dramatic drop in the rig count since reaching a recent high in 2023. Completions have been slowing as DUCs, these are drilled but uncompleted, continue to build, and completion deferrals will allow inventories to normalize, which sets up a positive winter potentially for natural gas. So there's another little highlights reel that you can take to the bank, because we should see a spike in natural gas, which obviously has been trading very, very low. And here you can see on the right-hand side a couple of graphs that shows you what the rig count looks like. Now, the current macro investment thesis, just very briefly, firstly, there's natural gas that's been price challenged, but there's a lot of optimism. And the post-COVID production growth plus the strategic petroleum reserve releases have helped to curb prices, but I think only temporarily. The rig activity continues to fall, but the higher demand and the lower rig count will help to limit oversupply, and export trends remain bullish as LNG exports continue to reach record highs. Those are all good things. From a current macro investment thesis point of view, the energy fundamentals remain strong. Now, energy is a sector that you can probably quite readily park some of your well-earned cash and cash-awaiting investment and hard-earned money into, but you need to be cautious and make sure you pick the right energy investment products. Despite the mixed macroeconomic data, some good, some bad, and obviously lots of stuff going on, including wars, there's inflation, there's supply demand, there's cost control, but there's continued favorable supply and demand. The supply demand favors energy investors as of this date. There's continued capital discipline by the producers. We've seen that. They've done balance sheet repairs. There's low price earnings ratios in general. The price earnings ratio for the energy sector overall is around 8, and for the S&P 500, it's around 15. The energy sector is producing high free cash flows, and their shareholders' returns are quite consistent in the variety of higher than average dividends. Energy companies, as a rule, pay more or greater or higher dividends than most most sectors. So the energy sector, pays more dividends than most sectors. And there are continued stock buyback programs that are also favorable to investors. So as a general rule, what I'm sharing with you here is a lot of information. And what you can do is you can take some of this information and hopefully something from this presentation will be beneficial to you as you build your own thesis for investment. As per usual, I remain energy bullish and probably will continue to be bullish from a mindset point of view as it relates to energy for at least another 3 years or so. But on an ongoing basis, of course, if I change my mind, you guys will be the first to know. So on that happy note, it's all positive, certainly from an energy sector point of view, despite negativity in the media and from politicians. So have yourself a great day, and hope you make lots and lots of money. Take care. Bye-bye.